The close of trading on Friday, June 26, 2026, revealed a stark split in the financial markets. We are seeing a distinct divergence between asset classes that usually trend together. Look at the technology sector. The Nasdaq dropped nearly 4.6% on the week, marking its fifth consecutive day of sustained losses as capital flowed heavily out of high-growth tech names. Compare that to the broader market. The S&P 500 remained relatively resilient, holding its weekly loss to around 2%. More importantly, the Dow Jones Industrial Average actually closed the week up 0.6%. The Dow comprises older, steadier, value-oriented companies with established cash flows. The Nasdaq is heavily weighted toward high-growth, speculative technology firms. This decoupling is a textbook example of a risk-off rotation. Capital rotation occurs when institutional money abandons highly speculative growth assets and actively seeks out the safety and steady yields of defensive equities. To understand why this flight to safety is happening right now, we have to trace a specific macroeconomic feedback loop. It originates with a supply bottleneck in the Middle East and terminates at the Federal Reserve in Washington. Identifying a systematic rotation like this proves the broader market is reacting to structural economic gravity, rather than isolated fatigue within the tech sector. We begin at the Strait of Hormuz. This narrow sea passage is a vital choke point for global energy distribution, handling a massive percentage of the world's daily oil supply. For over 3 months, geopolitical conflict has severely restricted transit through this specific corridor, forcing global oil production and shipping to a crawl. This causal diagram tracks extreme oil volatility. Brent crude swung wildly, spiking past $110, plummeting below $60, and stabilizing near $75. Oil powers logistics. When crude fluctuates this wildly, baseline operating costs for transport and manufacturing immediately scale up. This creates a supply-side shock. Price increases driven by raw material shortages cannot be solved by standard market efficiency. The physical goods simply do not exist in high enough quantities to meet demand. Factories and logistics networks pass these rising operational expenses directly to consumers. The result is broad, sticky inflation that embeds itself across the economy. Supply-side shocks bypass typical market controls. When structural inflation sets in, central banks are forced to step in with aggressive, sustained monetary intervention. The central bank in the United States is the Federal Reserve. Their primary mandate is to control inflation, and they use interest rates as their primary lever to cool off the economy. In their latest meeting, the committee led by Chair Kevin Warsh held the baseline interest rate steady at a highly restrictive 3.50 to 3.75%. This is the fourth consecutive meeting they have maintained this elevated level. Our diagram now adds the Federal Reserve as the second critical node. The Fed establishes the baseline cost of capital for the entire financial system in direct response to that sticky inflation. The cost of capital dictates exactly how expensive it is for corporations to borrow money. Sustained high rates make financing prohibitive, intentionally slowing down business expansion to cool consumer demand. The underlying data spooked the markets. The Fed officially raised its 2026 inflation forecast to 3.6%, and signaled that a further rate hike is now on the table for later this year. This directly contradicts earlier assumptions. Investors had aggressively priced their portfolios under the expectation that the Fed was preparing imminent rate cuts. A higher baseline cost of capital changes the math for every investor, forcing the market to demand higher immediate returns for the risk taken, triggering a swift repricing of assets across the entire economy. This hawkish reality directly triggered the June 26 tech sell-off. The damage concentrated heavily in high-beta assets. Volatile investments relying heavily on long-term growth projections. This addition to the chart maps multiple compression. Capital is actively draining out of high-beta AI equities and seeking shelter in low-beta traditional value stocks. Multiple compression is a mathematical reality of high interest rates. When the baseline rate rises, the present value of a company's projected future earnings drops, immediately making speculative tech companies look overvalued. A specific catalyst accelerated this rotation. Reports emerged that OpenAI might delay its stock market debut until next year, prompting nervous investors to lock in their past profits and exit the sector. The impact expands rapidly to the highest beta asset class available, cryptocurrency. Bitcoin recently touched multi-month lows around $60,558, and Ethereum slid below $1,600. To understand why crypto suffers here, you have to factor in opportunity cost, the potential return you forfeit by choosing one investment over another. Cryptocurrencies do not generate intrinsic yield. When the Fed allows safe cash to yield 4% risk-free, opportunity costs rise sharply, directly triggering capital outflows. In a restrictive monetary environment, long-duration growth and zero-yield assets lose their appeal. They become mathematical liabilities to institutional portfolios seeking guaranteed returns. This completed causal loop summarizes the current market environment. The entire structure is interlinked, and pressure at the geopolitical level cascades all the way down to retail portfolios. The equation governing the market right now is straightforward. High interest rates plus geopolitical uncertainty equals systematic multiple compression across risk assets. However, there are circuit breakers that can reverse this cycle. The primary override involves back-channel diplomatic talks hinting at a U.S.-Iran peace deal. A diplomatic resolution would unblock the Strait of Hormuz. That single action drops energy prices, cools down global inflation data, and ultimately provides the Federal Reserve the data-driven justification required to finally cut rates. The second circuit breaker counters the panic around AI valuations. We have to separate the day-to-day volatility of public stock multiples from the actual physical capital expenditure being deployed by these corporations. Look at the physical infrastructure being built. OpenAI and Nvidia recently announced a massive partnership to construct a 10-gigawatt computing facility. That project is backed by up to $100 billion in direct Nvidia investment. The long-term conviction regarding physical AI infrastructure remains ironclad, regardless of how public tech stocks trade this week. Proper market analysis requires separating these two timelines. You must distinguish between a short-term capital rotation driven by monetary gravity and the long-term structural value created by physical infrastructure and enterprise demand.